the American economy has been, ever since it's existed, a very strong engine for wealth accumulation.
Our next question is from Christy in Maumelle. I've got a few mutual funds, but I'm worried about asset allocation. I've got growth and aggressive growth, but nothing that's considered more quote-unquote safe. I'm only 47. Do I need to diversify? Well, Christy, if you have a few mutual funds and that's all you have, you're probably not adequately diversified. But I think it's important to talk about the difference in what you may be thinking is diversifying and what we would consider diversifying, because she's talking about asset allocation and leaning towards something more safe. And I don't think, John, at age 47, that's necessarily the focal point.
If your focus is retirement, probably not. Retirement is a growth activity. You need to be able to keep pace and stay ahead of inflation and taxes as you build your retirement assets, as you are building your wealth. And a bond portfolio, which you would think would be a more safe option than maybe equities or something like that, that's going to be kind of a slow go for you. And so it's going to be very hard for you to stay ahead of those two factors, inflation and taxes, if you're not leaning into equities. But now, equities is a very broad term. You're in a situation where you may be focused on maybe a few mutual funds. And Scott, I have to say that in most cases these days, they're probably large cap growth funds, because large cap growth is a sector that has been on fire for the last several years. But there is more to life than a large cap growth fund. And I will tell you that to be properly diversified, again, across all of the asset classes in the equity sector makes a lot of sense. You may want to have some real estate in there. Real estate is a growth and an income type portfolio. It does provide some additional diversification, but there's a lot of different options out there as far as diversification without going into something safe, because what you really need is that compound interest taking a hold between 47 and let's say 67, a 20-year period of time there between now and retirement, that you can really make some tracks with what you've got invested.
Yeah, bottom line is you could diversify within the equity asset class. You don't necessarily have to go to what you may be thinking as safe money, because again, the ups and downs, the volatility of the market, and we don't know where these mutual funds are, but typically people are holding those inside of their retirement accounts at work, like a 401k. But if you are adding to, and it could be anywhere, it could be in an investment account, it could be an IRA or a 401k, if you are adding to, making monthly contributions, that volatility is your friend. When the market goes down, you're buying shares of those investments on sale. And obviously a safer investment's not going to be as volatile, typically speaking. But there is a need as you get closer to retirement to start to diversify into safer, quote unquote, safer asset classes. I got a graphic here to show you, because it is all about time. There's a reason that the Gen Wealth logo is a clock, because it is all about time. And we mentioned already that Christy's 47. So if you have what could be an 18-year time horizon to retirement, let's call it 20 years for Christy, but she's going to work until she's 67. Look at the probabilities here, if you're watching on the video version of the Get Ready for the Future show, of a positive return in the S&P 500 index. If you go all the way back to its beginnings, you can see that any single day of the market there's a probability of a flip of a coin, right?
Yeah,
53% chance you're going to have a positive one-day return in the S&P. If you go out to 1 month, it's about a 63% chance of probability of a positive return. Out to 1 year, it's 77.5%. And if you go 3 years, it's 87.3%. 5 years, it's 92.6%. And 10 years, 97.3%. So again, the point of this graphic is to say that if you have time on your side, being quote-unquote aggressive lets you work out that volatility.
Yeah, that volatility, as you mentioned, is your friend if you're buying shares in this portfolio. So over this period of time that Christy is talking about here, I think that you stay with a situation where you are pretty aggressive with what you're doing, relatively speaking. Now, I'm not saying throw caution to the wind and go into micro cap stocks, with all of your money or anything of that nature, but you do want to be invested in the economy. Regardless of what you hear on a day-to-day, week-to-week, month-to-month basis about where we are in the economy, the American economy has been, ever since it's existed, a very strong engine for wealth accumulation. And so we think that that's the place to be. We're making an assumption here that this is retirement money and that you've got a 20-year time period. If you're going to use this money in some shorter period of time, then our answer might be a little different than what it was, in the last few minutes. But as long as you've got that time, Scott, you mentioned very adeptly that the clock of Gen Wealth's logo is all about time. And we want you to understand that concept because it's time in the market, not timing the market, that makes the most sense.
And I would say, just to wrap this up, Christy, don't go it alone. You're asking for advice on asset allocation. Work with a financial advisor. Even if those mutual funds are in a 401k and you're making the decisions on that, you could still work with the consultation of a financial advisor to help you choose among the options you have in that 401k. And if they're outside of the plan and you have an IRA, get some advice on those assets from a financial advisor because they're on top of this. We look at this every day. So just having everything in a large cap growth fund, as John said, may not be the way you need to diversify, but you can look at other diversifications within the equity asset class.